Hello, Marc Ostwald from ADM Investor Services International. Basically tagging on from last week with a slightly different tack in regards to the global outlook, particularly looking at it in terms of the volume of corporate issuance, looking in terms of what commodity prices are telling us about the outlook, and above all, how much benefit is actually accruing to riskier companies in the corporate sector from the huge amount of stimulus that's being pumped in, and precisely how much the big debt accumulation that we've got is doing to global prospects. So let's start off with the Goldman Sachs Commodity Price Index. In my first chart, against the WTI second month contract. I use the second month simply because we've had all those distortions in the oil market. And what we can see there is obviously we had a very sharp fall through much of the early part of the year, and we have since seen a recovery, but it's all primarily, as one can see, mirroring the recovery in the oil prices. And yet, of course, oil prices are very far away from where they were earlier in the year, let alone when people were talking about $80. So I'm not sure that this necessarily actually tells us a lot about the global economic outlook. Secondly, today we've had the Chinese National People's Congress meeting. The measures on Hong Kong are obviously going to heighten global geopolitical tensions, which is not conducive to growth. But just as importantly, we've also had an off meeting, i.e. unscheduled meeting, rate cut in India of 40 basis points, not huge in the greater scheme of things, but that doesn't actually say a lot for the government's fiscal stimulus package, and above all, its economic forecasts, projecting nothing more in a no significant recovery in the Indian economy before the second half of 2021, not 2020. Really doesn't say much with the Chinese National People's Congress also dropping its growth target about prospects for the world's two most populous countries in terms of their growth prospects. And without them, and with prospects for Latin America being fairly dire, and we're like the likelihood that we'll see a fairly haphazard recovery in both Europe and in North America, it's very difficult to see where all the optimism on global growth is coming from. Now, for my second chart, or second and third charts, I want to talk a little bit about something a little bit technical, which is the global monetary base. As one can see in chart one, this is a chart of a proxy for the OECD monetary base. As one can see, basically in the last few months, it's basically grown as much as it did in the prior 15 years. And that is all to do with the liquidity injections and the debt that's being issued. For my third chart, we see what this does to monetary velocity. And this is specifically looking at the United States. So one can see the big jump in the US M2 stock there. And one can also see the big drop in monetary velocity. Monetary velocity is important for the simple fact that it's basically measuring the amount of the rapidity with which money changes hands. The slower it changes hands, the less good the prospects for global growth or for a national country's growth. It speaks for itself. My final two charts are, and this basically compares US high yield versus US dollar denominated Asian high yield and the JP Morgan EMI emerging market bond spread. We've seen a tightening of spreads of late, but they're still way above where they were. Last but not least, and I think this needs to be taken into account, my fifth table is basically just showing the amount of issuance that we've had year to date relative to last year. And both in the case of investment grade and high yield, issuance is already up year to date by around about 45%. That will obviously bear down on that monetary velocity. And those are the thoughts for this week.